Hello and welcome to this, our fourth episode of Mic'd Up with ICM. My name is Pete Seyler. I'm a member of the business development team here at ICM. I'm excited to again be joined today by Ryan Lehman, Director of Investments here at Integrated Capital Management. Ryan, thanks for joining us.
Happy to be here, Pete.
Great. Well, hey, a lot of stuff going on in markets right now, and what's really risen to the top of people's minds is what do you feel was behind this summer rally, despite the Fed continuing to increase interest rates and really showing no signs of stopping in the near future?
Yeah, sure. So that's a really great question. So that summer rally, which was pretty much full steam up until Chairman Powell's speech in Jackson Hole last Friday, that was largely driven by financial conditions loosening, which is clearly not the intention of the Fed right now, whose goal is to break the back of inflation. And what I mean by loosening is that you saw equity markets increasing, you saw credit spreads tightening, and then you also saw interest rates declining pretty meaningfully, especially at the longer end of the curve. And this all runs pretty much directly counter to what the Fed is doing right now, which is raising interest rates in an effort to tighten financial conditions and inevitably slow down demand a bit.
Okay, good information, and we've heard increasingly from a lot of folks, this idea that the Fed is going to pivot, and that's really being thrown around an awful lot, even in financial media. How does that idea play a role in this?
Yeah, I mean, it definitely does. So that's another factor that played a pretty important role in the market's recent rally. And for anyone who isn't aware, the Fed pivot, that's the idea that the Fed is going to move away from how restrictive their recent monetary policy decisions have been. And the reason I kind of put pivot in air quotes is because slowing down the pace of rate hikes or even pausing for a bit of time isn't necessarily easy monetary policy. The Fed's already hiked rates from 0 to 250 basis points. And if you get another 50 or 75 basis points in September, like the market's expecting, that's going to put the Fed funds rate at over 3% for the first time in about 15 years. A more realistic definition of the word pivot would be an actual reversal in policy where the Fed moves from a rate hiking campaign to a rate cutting campaign. But like Chairman Powell implied in that Jackson Hole speech, the Fed is probably going to need to keep rates higher for longer in order to combat this current inflation environment we're in.
So, in your estimation or your opinion, do you believe a pivot's even plausible at this point?
Well, a true pivot next year, it isn't completely out of the realm of possibility, but we aren't going to break the back of inflation or break inflation if markets continue to rally, rates continue to decline, and credit conditions remain loose or get even looser. So in reality, what's possible is that investors and markets, they're going to need to experience a great deal of pain from now until then if we are going to get to the point where the economy is pushed into a deep enough recession to cause inflation to decline in a meaningful way and the Fed to actually pivot from increasing rates or leaving them constant to actually cutting rates at some point.
So it's a really interesting perspective, and I want you to play prognosticator here for a second. What do you expect for markets in as we head toward Q4?
Yeah, well, unfortunately, we're probably going to see a continuation of this volatility that we've experienced for much of the last year or so. And a lot of that's probably going to be driven by this current disconnect that we've got between equity and bond markets. And what I mean by that is if you look at the yield curve, you have the 2-year at or near its highs for the year, which is basically implying that the market's outlook for a continuation of those higher rates, as well as elevated inflation, at least in the near term. And then if you look farther out on the curve, you're inverted at the 5, the 10, and the 30-year points, which tends to be a pretty clear indicator that the market expects a recession or rates to be lower at some point in the future. However, when you look at what's going on with the equity markets, the S&P rallied by more than 9% in July, so the big rally we're talking about. And up until just the last few days or so, was only trading lower by about 15% on the year. And then if you look at where valuations are, we like to look at CAPE ratios. If you look at the 10-year CAPE at the end of the July, that was about 28 times currently versus the long-term average that's closer to about 17 times. And the concerns we have with that is that if the bond market's correct, and we tend to believe what the bond market's telling us more than the equity markets right now. Equity market valuations at these levels, they just aren't sustainable. And as a result, US stocks are likely going to face some volatility in the coming months as inflation and likely an economic slowdown is going to start to creep its way into corporate earnings and then subsequently start to creep its way into lower equity prices.
Great. And let's end on one last question. What's the best defense for volatility? Is there any way to protect a portfolio?
Yeah, there's a couple things that investors can do in this type of environment. First, and this kind of goes without saying, stay diversified. And I know this might be a little bit less appealing than it has been historically because of what happens or what has happened in bonds over the last year. But at these levels for bonds, they look much more attractive than they did at the beginning of the year. And this isn't just from a yield perspective. They're also in a much better position to provide that inverse relationship or that negative correlation with stocks that we've historically seen during periods of market stress or periods of volatility. And then second, our advice, it would be just to stay disciplined in your approach to investing and to avoid those overvalued segments of the market, because those are the parts of the market that are going to tend to be the most negatively impacted during periods of market volatility or any type of significant drawdown. And that's pretty much what you've seen over the last 12 months or so with a lot of those lower quality, higher valuation growth stocks. They've really gotten beat up lately. If we look at just what the NASDAQ has done on a year-to-date basis, you see the NASDAQ is down about 25%, so clearly in bear market territory, versus broad U.S. stocks, which are down closer to 15%.
Great. Ryan, again, absolutely appreciate your time here today for this episode of Mic'd Up. We appreciate your insight as always and look forward to a future episode. If you do have any questions, feel free to reach out to us here at Integrated Capital Management. Always happy to spend time with advisors. We can be reached at info@icm-invest.com or by phone at 888-426-4689. We hope you enjoyed this episode.